Hello and welcome. Today we are reviewing Holologic Inc., ticker HOLX. Over the next few minutes, I'll discuss my thoughts on both valuation of this company and its business quality. This company has a market cap of $18.8 billion, enterprise value of $18.8 billion. So you can see that they have no net debt on this business. That's a really good sign that they're not needing additional debt in order to boost their returns. You do like to see that in a company. They are operating in the healthcare equipment and supplies industry. So Holologic develops, manufactures, and supplies diagnostic products, medical imaging, and surgical products for women's health through early detection and treatment in US, Europe, internationally. So they have diagnostics, breast health, GYN, surgical, and skeletal health. So the medical device industry tends to be a pretty good industry. You can have some very strong moats as companies really specialize in very focused areas, but they do certainly face some competition depending upon how big that area is. Women's health would, of course, be a very big area. Breast health, GYN, these are not small areas of the business. So they have diagnostic assays, infectious microorganism, viral loads, so Hep B, Hep C, COVID testing, some x-ray systems. I don't really know much about a lot of these different areas, but presumably they're here for detecting, some different things like breast cancer, I would assume is a big part of this business, but it's too hard to tell directly. So it has direct sales and service forces. Okay, so return on invested capital. What can we learn from it here? One of the things that's really important to me is how many years of profitability do you have, how predictable it is that you're going to make a profit, and what is that profit going to look like? So we see 1, 2, 3, 4, 5, 6, 7, 8, 9 years out of the last 20 years, they've lost money. So that on its own, for me, is going to be a disqualifier because I don't like companies that almost half the time they're losing money. Because what's really helpful for a shareholder to compound their money well over the long term is you're looking for some common things. You're looking for profits, you're looking for growth, you're looking for sustainability and reliability. So right here we're saying is we're not getting profits sustainably or reliably because we're only getting it in 11 out of the 20 years. And so then the only way you can really make high returns with that is that the years that you do make profits, you make really strong returns on capital. We do see that in 2020. So you have 20%, 28%, 17%. These are really good numbers. But then your other peaks aren't as strong. You see 12% in 2017, 3% in 2011. 12%, 14%, 2005. You have a lot of years that even if you're making a profit, it's a low profit like that 3%, 2%, 5%. These numbers are not very attractive to me because I'm seeing that even when they're making a profit, they're not making very strong returns. So even if you average them out and they're okay, it's going to be an up and down. It's going to be very hard to predict. And when that is going to say, hey, this is an average company, this is maybe even a below average company, because that's a lot of years of losses. And so it's not going to be a high quality business. You can see this as well when we go to these 10-year median returns. Your return on invested capital is 4%. The return on equity is 11%. So there is some inherent leverage in there. I'm not really sure where it's coming from because you have the no debt. So it has to be some non-debt leverage that we're seeing. But return on equity of 11%, return on invested capital 4% are both below my targets of 10 and 15 respectively. So I would really like those numbers to be higher, and I would really like a more predictable return on invested capital. On top of that, you're paying a very high price for this business. PE of 39 is extremely expensive for even a high quality business trading at such a price, but we're already seeing this as relatively low quality business. Why would something be this high? It's got to be growth and growth potential. You can see that they've gone revenue in 2.4 billion to 5.6 billion as of 2021, 4.8 billion in 2022. Their operating profit is up eightfold from 2013 to 2022, 281 million to 1.6 billion. So you can see it's that massive growth, 21% free cash flow growth that's really driving this price. But the problem is you're not predictably making a profit. It's up and down all over the place. And so that makes it really hard to rely on. When you have something like this where your operating margin has gone from 11% to 33%, that's showing you some of the potential problems here because it means that you can't repeat that again. You can't triple your operating margin over the next decade because that would mean an operating margin of 100%. It's not going to go that much higher. I do like seeing operating leverage where you see gross margins go from 46% to 61%, but again, it's not going to be repeatable. So your growth is going to revert back towards your revenue growth, which is in the single digits. And when you do that, your PE is likely to come down as well. So Most likely, this business is significantly overvalued. One check we'd want to make, though, is, do the current earnings, kind of understate the earnings power? We can see $5 here in earnings against $75 on the price here. So if you were PE of 10, you'd be at 50. PE of 15 gets you to 75. Now, PE of 15 sounds much better than PE of 39, so I don't really know why that is being shown there. But even then, this could be overstating the pricing because you see that they've not been earning this a reliable number. Only 1 year out of the last 10 years has it been higher than $5. And so it's probably the trailing 12-month numbers are even worse. And we're going to see that when we go to the income statement next. If you're learning something, if you're enjoying this video, hit that like button. The likes don't mean you like the company. It's just about the videos, helps me to grow the channel. So please consider supporting me in that way. So as we look at the income statement, you can see here this gross profit's gone up from 1.1 billion to 2 billion. They're actually at 3 billion in 2022. You can see that what's actually happened is in 2023 so far, their earnings are getting worse and worse. Revenue has fallen off a cliff from 5.6 billion to 4.8 billion down to 4 billion. So you had actually grown much, much faster if you're benchmarking to 2021, 2022, but your growth has collapsed. Now, what I'm guessing is what's unique about 2021, 2022. Obviously, you had COVID. If they incorporated, like they say in this summary, COVID-2 assays, detection of COVID, they probably have a lot of COVID testing income. As that income falls off, the company is actually going to be worth much less than it might have been worth in the past if you had extrapolated these numbers. And you can see that they've already lost basically 2/3 of their income from 2021. And the problem is that money's probably not coming back. Their normalized earnings on an operating profit basis looks like it's in the range of $500 million. So if your operating profit is $500 million, your enterprise value is, $18 billion. So you're saying that you're at, 38, 39 times that business. So that's actually a pretty accurate assessment of what this business is worth. This is an extremely overvalued business from what I'm seeing here. And it's probably because you had these COVID numbers that have come in one time. As the business reverts and you start getting this EPS closer to $2 a share, you're going to be a little bit less attractive. Now, we have seen they've bought back about 10% of their shares outstanding since 2014. Even more if you compare to 2015, almost 15% since 2015. So maybe you're adding 1% a year to your EPS through stock buybacks. But again, that's probably been able to execute because they created so much cash in that time frame. I wouldn't necessarily rely on that in the future. Now, the balance sheet, goodwill's gone down a little bit. That's good. Total current assets has doubled. It looks like a lot of that is cash, though, so I can kind of ignore that. PP&E is really low. Here, let me reset this. So PP&E is actually pretty low, 500 million in PP&E. So that's good because if you're able to earn $500 million in operating profit on $500 million of PP&E, you're not carrying a lot of inventory, maybe $500 million in inventory. You're getting 50% type returns on your tangible assets. That's actually pretty good. So you have good tangible returns on assets. Your intangible assets have actually gone down a little bit over time. So your assets have declined a little bit over time. That's a good sign. I'm pretty happy with that. You do have debt, but they've been paying it off. You had $5 billion in debt. Now you're down to $2.8 billion. And that's matching off really well with your cash equivalents and accounts receivable. So I'm pretty happy with what I see from a balance sheet perspective. It looks like the balance sheet is being managed pretty well. Let's go to the cash flow statement. Now, one key thing is you have depreciation and amortization. This is a pretty significant amount, 400 million. So your cash flow is going to be a little bit higher than your net income because you have such high depreciation and amortization. And that depreciation and amortization is exceeding significantly your PP&E, which is a good thing because it means you're not having to reinvest as much money into the business as you had to do up front. And so you're going to get this benefit of higher cash flow numbers than net income numbers. And that seems like a realistic assessment of what the business is doing. So I'm pretty happy with that. They're using some of this excess money to pay down debt, using that money to do buybacks since 2015. So pretty good sign there as well. I like how the cash flow is being managed. So overall, the company's being managed pretty well. I think what's happened with this business is that There is some underlying unpredictability. So you have that unpredictability in their testing and the equipment sales. And so that's an underlying problem for the business. But in terms of how it's actually being managed, when the cash comes in, the management seems to be doing pretty well with it. It looks like they probably pivoted in 2020. They took advantage significantly of COVID, because if we just look from 2013 to 2019, you see they grew from 2.5 billion to 3.3 billion in revenue. That's basically the growth rate, right? You see a bunch of years of single-digit growth, 1.5%, 6.9%, 4.7%, 8%, 5%, 4%. That sort of growth rate is probably what I would consider more normal for this business. This 12% and 49% would be abnormal, and it looks like we're reverting since then back down to the normal business ex-COVID. And so you need to assess this company, kind of ignoring that COVID didn't exist. If you want to get a really good valuation, I would go into these years 21, 2022, and I would just remove all COVID revenues from it in order to assess what the business is going to do going forward. And when I look at something like that, I see a business earning maybe $500 million in operating profit from what I can see here, $500 million in operating profit that's not growing that fast. So now I'm going to say, okay, I want to be in a 10 to 15 type PE on that operating profit. Maybe we're talking about, $5 billion company, $7 billion company. I don't know if I'd want to pay much more than a $7 billion company. So it shows the level of overvaluation here. And that's despite the fact that, again, it's not a super high quality business. So you want to be paying a low price for that. I think the business is maybe 2/3 overvalued. And so for that reason, I would not own this company. And I don't think it's going to make my watch list because it's not a high quality enough business. If you learned something from this video, hit that like button. Don't forget to subscribe. We're covering every company in the S&P 500. I hope you'll check out those videos on my channel. Thank you for listening. And until next time, stop paying fees, start building wealth.